You know, usually when we talk about investing in a specific sector, it feels like looking at a map where all the borders have been drawn for decades.
Right, it's very static.
Yeah, you have your legacy players, your established supply chains, and, well, you generally know who owns what territory. But then you look up. You look at the commercial space industry as of right now, June 2026, and suddenly that map is being rewritten in real time.
Oh, it's the absolute definition of a frontier market, but, with a massive gravitational shift that just happened.
Right. And that shift has a name, the SpaceX IPO. The moment they went public, it fundamentally transformed the financial landscape of space exploration. I mean, it gave everyday investors direct access to the undisputed heavyweight champion of the cosmos.
Yep.
But in doing so, it created this massive shockwaves. And suddenly everyone is looking at the rest of the industry, wondering what it means for everyone else.
Because when a giant enters the public market, it changes the gravity in the room. It pulls capital, it pulls attention, and it forces every other company to ruthlessly justify their existence.
Exactly. And we have a fascinating piece of financial analysis from Pythia Research today. They are zeroing in on one specific company caught in this gravitational pull, Rocket Lab, trading under the ticker RKLB.
Right. It's a really interesting case study.
We're going to explore why Rocket Lab's stock still matters immensely, how their entire corporate strategy is betting on the changing dynamics of global infrastructure, and what the real tangible risks are for retail investors navigating this completely new post-SpaceX IPO world. Okay, let's unpack this, because to understand where Rocket Lab is going, we first have to address the elephant in the room, the stock charts.
Yeah, the recent stock performance has definitely caused some elevated heart rates among retail investors, to put it mildly.
That is putting it mildly. I mean, according to the Pythia research note, we saw a sharp rotation of capital right after the SpaceX IPO. Rocket Lab dropped over 22% recently, while SpaceX actually rose over 16%.
Right.
If you are an everyday investor holding Rocket Lab, looking at that chart, your instinct is probably panic.
It's a very natural instinct. But to understand what actually happened, we have to talk about a concept called the scarcity premium.
The scarcity premium.
Yeah. Before June 2026, if you were a portfolio manager or a retail investor and you wanted exposure to the booming space economy, your options were incredibly limited. I mean, SpaceX was private. So what do? You buy Rocket Lab.
Right, because they were the closest publicly traded proxy.
Precisely. They were the default choice. Investors were parking their money in Rocket Lab, not necessarily because they were obsessed with Rocket Lab's specific granular business model, but simply to get a ticket to the space theme.
Just to have skin in the game.
Exactly. The company enjoyed a premium valuation just because of a lack of alternatives. It is a phenomenon we see in markets all the time when a new sector emerges.
It's like being the only indie rock band on a record label, and suddenly the label signs the Beatles. Everyone panics for the indie band, but their own shows are still completely sold out.
That is a perfect analogy.
When a massive global act suddenly opens up on the same label, that premium is going to crash, even if your own band is still playing its normal tour schedule.
And that dynamic is exactly why the Pythia analysis argues that investors should view this recent volatility, this 22% drop, as a fundamentally healthy correction.
Healthy. Okay, you have to explain the mechanics of how losing a fifth of your market value is healthy for the long-term retail investor.
Because it washes out the tourists. It removes the excess expectations of the people who were just front-running the space theme.
Ah, I see.
Those investors have now successfully rotated their capital into SpaceX, which is what they wanted all along. What is left behind is a shareholder base that is actually focused on Rocket Lab's operational reality.
Right.
And crucially, the source material points out that Rocket Lab's fundamentals, their revenue growth, their margin improvement, and the expansion of their backlog, they remain completely intact.
So the business hasn't degraded, only the perception of scarcity has vanished.
Yeah.
But that forces a really tough question. If they have lost their status as the only game in town, what is their new identity to investors? I mean, if I'm an investor looking at a landscape dominated by a giant, what exactly am I buying when I buy Rocket Lab now?
You are buying a shift from a scarcity story to an infrastructure ownership story. Rocket Lab now has to stand entirely on its own operational performance, which is exactly what long-term investors should want.
Here's where it gets really interesting, because the core of Rocket Lab's new opportunity, according to this research, isn't about trying to beat SpaceX. They aren't trying to steal their market share.
Right. Pythia Research says it's very difficult to see a way for Rocket Lab to directly compete with SpaceX's scale, manufacturing, and the sheer economic power of something like Starlink.
Yep.
And they don't need to. That is the fundamental misunderstanding many investors have.
Yep.
Rocket Lab's entire strategic identity now revolves around becoming the crucial second strategic launch provider.
Number two, they are actively strategizing to be the backup.
It sounds counterintuitive in a corporate world obsessed with being number one, but in the realm of sovereign infrastructure, being the established number two is an incredibly lucrative and protected position.
Let's break down that term, sovereign space infrastructure.
Yeah.
What does that actually look like in practice for governments and national security programs?
Think about how modern governments operate. They almost never allow themselves to become entirely dependent on a single supplier for critical technology.
Oh, right. Just like with semiconductor chips or cloud computing.
Exactly.
If the Pentagon needs a cloud server, they don't just hand the entire contract to Amazon AWS, they actively split it with Microsoft Azure.
Precisely. Once a technology becomes strategically vital to national security or global communications, having a credible alternative isn't just nice to have, it is a mandatory requirement.
A backup plan.
A government cannot risk a single point of failure. If one company faces a labor strike, a massive technical failure, or a geopolitical complication, the government's access to space cannot simply shut down.
So the irony here is just massive. SpaceX's overwhelming dominance is actually Rocket Lab's best customer acquisition tool.
It really is.
The bigger SpaceX gets, the more nervous governments get about being reliant on them, and the more desperately they need Rocket Lab to succeed. Customers don't want to replace SpaceX, they just desperately want an alternative to avoid a monopoly.
If we connect this to the bigger picture, it completely reshapes how we should evaluate Rocket Lab's upcoming technology, specifically their new, larger rocket, the Neutron.
Right, Neutron is the medium-lift launch vehicle they are developing. And a lot of retail investors probably look at Neutron and think, okay, this has to be better, faster, and cheaper than the SpaceX Falcon 9, or it's a failure.
But the mathematics of a dual supplier ecosystem dictate otherwise. The threshold for Neutron's success is so much lower than most investors assume.
Really? How so?
Neutron does not need to beat the Falcon 9. It simply needs to be reliable enough to serve as a credible alternative. The sheer geopolitical necessity for a backup provider guarantees them a seat at the table. They just have to build a rocket that works consistently, and the contracts will inherently flow their way to maintain that market balance.
Okay, that makes sense for market share.
For that
But let's talk about the size of the market itself, because we aren't just looking at two companies fighting over a static, fixed number of satellite launches, are we?
Not at all. And this is another area where the SpaceX IPO pulled back the curtain for the whole world. The IPO revealed a company operating with approximately $18.7 billion in annual revenue.
$18.7 billion. For context, just a few years ago, the idea of a commercial space company generating that kind of capital was pure science fiction.
It was unimaginable. But despite SpaceX injecting all of this massive supply of launch capacity into the market, the demand is still surging. The Pythia report notes that government contracts, sovereign space initiatives, and multiplying satellite constellations, they are continuing to grow at an astonishing rate.
We really are in the early stages of understanding the true, total addressable market of the space economy. It feels like every time supply increases, new use cases emerge that demand even more supply. Why is that? What are these satellites actually doing up there that's driving so much demand?
Well, we are seeing a fundamental shift from space being a niche scientific endeavor to becoming the underlying infrastructure for the global economy.
Okay.
For one, defense budgets are actively shifting towards space technologies. Militaries around the world rely on space for secure communications, missile warning systems, and precise GPS targeting.
Right.
On the commercial side, you have massive constellations being built for Earth observations, monitoring agriculture, optimizing logistics, tracking global shipping lanes in real time. And then you have the sovereign space initiatives.
Right, sovereign space. Because it's not just the U.S. and a few major players anymore. You have nations all over the world realizing that if they don't have their own secure satellite networks, they are essentially outsourcing their national security to whoever owns the data feed.
Precisely. If a nation wants its own secure communications network, completely independent of foreign corporate control, they need a launch provider. And often, for geopolitical reasons, they specifically want a provider that isn't already dominating the global market.
They want a dedicated partner.
Exactly. So we are looking at a growing ecosystem where demand is likely to exceed supply growth for a very long time.
But wait, let me ask a clarifying question here for you, the listener, because I want to make sure we're seeing the full picture.
Sure.
If the demand is growing so incredibly fast, and there's more money than there are rockets to launch it, does that mean Rocket Lab can just comfortably coast on the overflow from SpaceX?
What's fascinating here is that the dynamic requires intense execution, not coasting. It is not about simply catching overflow. It is about establishing themselves as a permanent structural pillar of this new economy.
Because they have to earn that spot.
Exactly. Remember, they're competing to be the second strategic provider. If they coast, a third or fourth company could easily step up, accelerate their development, and take that vital number 2 slot.
Oh, that makes sense.
By actively capturing that wave of capital that inherently cannot go to SpaceX because of that need for diversification we discussed, Rocket Lab cements its position. They have to execute flawlessly to earn and keep that trust.
And that brings us crashing back down to Earth.
Yeah.
Because the strategic positioning sounds absolutely brilliant on paper. The dual supplier ecosystem, the expanding market being the vital number 2, it's a great story.
Yeah.
But retail investors aren't just buying a story, they're buying a stock at a specific price. And the source material has some stark valuation metrics that we really need to dig into. How does the current price tag reflect this reality?
Well, the valuation is where the rubber meets the road, and the SpaceX IPO gave us a brand new, highly accurate benchmark to judge Rocket Lab against. Prior to the IPO, it was very hard to know how to value a high-growth space infrastructure company.
So let's look at the numbers. Pythia Research points out that SpaceX is generating that 18.7, let's say, nearly $20 billion in revenue, and they are trading at 26 times sales. Rocket Lab, on the other hand, is just approaching $1 billion in revenue, but they are trading at roughly 77 times trailing sales. I want to pause on that term, trailing sales, because it's important. That means looking in the rearview mirror at the revenue they've already generated over the past year, right?
Correct. You're looking at the historical performance. And compared to SpaceX's 26 times multiple, 77 times is a massive premium.
But the report also brings up another metric. It notes that if you look at forward enterprise value to sales, which factors in the company's debt, their cash on hand, and crucially, their projected future revenue, the gap actually narrows significantly.
It does.
It sits at about 56 times forward EV to sales for SpaceX versus 59 times for Rocket Lab.
Right, because the market looks at growth stocks by pricing in the future. By factoring in the cash they hold and the revenue they are expected to generate next year, the market is effectively saying that, relative to their future potential, Rocket Lab and SpaceX are actually trading in the same neighborhood.
So what does this all mean? Wait a second. Paying 77 times past sales, or even 59 times future projected sales, for a company whose entire corporate goal is to be the backup option. That sounds incredibly risky for an everyday retail investor.
It is a lot of pressure.
It feels like the market is already pricing in their success before they've fully achieved it. Isn't this stock basically priced for absolute perfection?
It is priced for exceptional execution. Yes, that is a highly accurate concern. The market is not valuing Rocket Lab as a traditional, slow and steady aerospace manufacturer. It's already giving them credit for being a vital future space infrastructure company today.
Right.
And when you are awarded that kind of premium multiple by the market, it means there is a rapidly shrinking margin for error.
It leaves almost zero room for execution mistakes. If you are priced like you've already won the silver medal, you cannot afford to trip on the starting block.
Exactly. And because that valuation leaves no room for error, long-term retail investors holding this stock need to have a very clear definition of what specific errors would actually cause this investment thesis to collapse.
Right, what are the actual tripwires?
Yeah.
Because it's easy to panic over every little headline, but we need to know what actually matters. And according to the text, the biggest risk is not what most people think it is. The biggest risk is not a minor delay in the launch of the Neutron rocket.
No, space is hard. Engineering timelines slip. Minor delays are factored into the industry's expectations. The true existential test begins after the launch.
Okay.
The real risk is weak customer adoption.
It's like spending a massive fortune to build a state-of-the-art backup power plant for a city. The real risk isn't that the construction finishes a month late. The real risk is that you finally finish it, you flip the switch, the power is hunting, it's ready to go, and the city decides they don't actually want to buy your electricity.
That is spot on. And if they build that power plant but no one buys the electricity, the market will abruptly re-rate the stock. If the Neutron rocket launches successfully, but the commercial bookings and the backlog of orders do not immediately accelerate, the entire second strategic provider thesis loses its power. The market will realize the capacity is there, but the demand isn't meeting the valuation.
And the research highlights that it's not just about Neutron. If the broader backlog growth slows down across their other segments, or if those lucrative defense contracts soften before Neutron reaches total scale, what happens then? Let's say the government decides to stretch out their procurement timeline over 10 years instead of 5.
This raises an important question. How can retail investors successfully monitor this? Because if that growth moderates, investors will abruptly decide they can no longer justify that high multiple.
So the stock tanks.
Yes, the market will correct the stock price downward to reflect a slower growth reality. This means you could see massive stock declines, even if the underlying business is technically still growing, just not growing fast enough to support the infrastructure valuation.
So as an investor, you can't just cheer for a successful rocket launch. You have to immediately look past the smoke and the fire of the launch pad and stare directly at the balance sheet.
You must intensely watch the backlog numbers. You have to separate the visceral excitement of a rocket launch from the cold, hard reality of commercial adoption. That transition from technical achievement to commercial scale is the most dangerous phase for a company with a valuation this tight.
When you look at it all together, it makes perfect sense why the SpaceX IPO caused such a panic. It stripped away Rocket Lab's scarcity premium. They went from being the only ticket in town to having to prove they can actually build the highway.
Exactly.
Losing that status caused some volatile but ultimately healthy market corrections. The tourists left, and the long-term investors stayed.
And that cleared the stage for Rocket Lab's true path to profitability. They don't need to be SpaceX. They are positioning themselves to become the mandatory, sovereign-backed #2 provider in an exponentially expanding space economy. They are leaning into the reality that governments and major corporations will always demand a backup.
But that strategic brilliance comes with a hefty price tag. Trading at those high multiples means the market expects flawless execution. Their upcoming Neutron rocket must not only fly successfully, it must immediately sell. The backlog has to explode with new orders to justify the stock price.
Right. Understanding these mechanics, the shift from scarcity to infrastructure, the necessity of a dual supplier ecosystem, and the unforgiving nature of high growth valuations is critical. Whether you are actively managing a portfolio holding a few shares of RKLB, or just fascinated by the economics of the new space race, this is how the future of global infrastructure is being built above our heads.
It really is.
It is no longer just about engineering. It is about strategic geopolitics and commercial viability.
It really changes how you look up at the night sky.
Yeah.
But before we wrap up this deep dive, there is one final lingering thought I want to leave you with. Something for you to explore on your own that builds on this idea of sovereign space infrastructure, but takes it one step further. We've talked extensively today about governments demanding a backup to SpaceX for national security. They want a second provider in a unified global space economy. But as space becomes the ultimate strategic high ground for defense and communications, what happens if geopolitical tensions escalate even further?
What if nations eventually demand not just a second provider, but a provider that is exclusively theirs?
Exactly. Completely walled off from rival nations. Could the demand for absolute, impenetrable national security eventually fracture this unified space economy we've been talking about? Could we see a future where there isn't just one global commercial space market, but entirely separate, competing national ecosystems orbiting right next to each other? Just something to think about the next time you see a rocket streak across the sky.